Shall we begin? We have a broad idea about various instruments, their characteristics. We will now move to an understanding of the securities market, which I call it the battlefield. I said there's a market where millions of trades are happening every day. People are engaged in a constant battle, each one thinking that he's smarter than the other, but collectively it's a dumb lot. Okay. I must make a confession. I come from a family of stockbrokers. My father was a stockbroker. My brother was a stockbroker. Everyone in the family is a stockbroker except myself. I am a maverick with an academic. So I have a very, very deep understanding of the stock market. I was also a member of the board of Bangalore Stock Exchange, Interconnected Stock Exchange of India, SEBI Committee on Derivatives, Capital Issues Advisory Committee. So I've had fairly decent exposure to policy making as well as stock market operation. That is why I call it as a battlefield, a non-zero sum game as professed by the key players, but really a zero-sum game in reality. Let us understand what this is how we'll structure our discussion, structure securities market, participants, primary market, secondary market, NSE, BSE, ALGO, indices, NSEX and Nifty, SEBI's trust, stock market reform, market evolution. Very broadly, this is how I look at the securities market. There are three broad components: the equity component, the debt component, and the derivatives market. The thrust of my discussion is on the equity market. The debt market is of interest primarily to institutional investors like mutual funds, pension funds, insurance companies. It is of very little interest to most of us as individual investors. The thrust of this course is on individual investment portfolio management. So I'll avoid topics which are of great interest to institutional investors. Derivatives market has thrived in India. This is essentially a speculative market. Time permitting, I'll give you some idea about this market, but again, my thrust is on giving you a set of guidelines which will serve you well as a long-term individual investor. There has been a veritable transformation. I have seen the Indian equity market evolve over the last 45, 50 years, and I can say no other country has transformed its equity market the way India has done. And this is largely because of technological advancement and policy regulation. Thanks to liberalization, automation, globalization, institutionalization, the market has been transformed and we have excellent regulation. The thrust of the regulation has been to improve market integrity, market efficiency, and investor protection. Very broadly, I can say that Indian markets are very safe if you want to buy and sell. There is absolutely no risk whatsoever. The market is a high level of integrity. If you are buying 100 shares, you are certain to get those 100 shares. There is no risk of default any time. This was not so in 1965, 1970. If I bought 100 shares of Bajaj Auto, I was not sure whether I would get those shares in the next 1 week, 2 weeks, 5 weeks. I've had horrendous experience where it took me 1 year and I got only 80% of the shares I actually ordered for and paid for, because the remaining 20% turned out to be fake shares. You don't have any such risk now. Market is very, very sound. There is no problem as far as market integrity is concerned. And the market is very efficient today. Information is available almost at the same time to everyone. Today's heavy information disclosure requirements are very tight. Insiders can't have an advantage over ordinary investors like you and I. And SEBI has instituted a number of mechanisms to provide investor protection. That way, it's a very, very easy to operate market. The thrust of reforms has been to move in these directions, make India more market-oriented, deregulation, automation, globalization, institutionalization. As far as the equity market is concerned, I found these as major changes. Emergence of Securities Exchange Board of India, which is now the regulator of the capital market, as well as the forward market. National Stock Exchange has transformed the character of the Indian equity market. National Securities Clearing Corporation Limited and National Securities Depository Limited. These four institutions have veritably transformed the character of the Indian equity market. If you look at the market, there are two broad parts to it. The primary market and the secondary market. The primary market is a market where a company raises money from investors by way of a public issue, by way of a rights issue, by way of a private issue. The secondary market is a market where outstanding securities are traded. Reliance may have issued millions of securities there, traded regularly in the secondary market. If you look at what has happened in the primary market, you find that we have moved to an era of pre-pricing. Earlier, pricing in the primary market was regulated and controlled. There was a body called Controller of Capital Issues. If Hindustan Unilever wanted to raise equity shares, that body would decide the price at which shares have to be issued. I was a member of that body for 4 years before it was dissolved and SEBI was created, and we used to sit on judgment on to what should be the price at which Reliance should offer its shares or convertible debentures. All that is gone. Now it is left to market forces. SEBI has come up with fairly detailed guidelines, issue of capital and disclosure requirements. There is a lot of emphasis on adequate disclosure. We have a very efficient delivery mechanism now. Everything is issued in everything is issued in demat form. Whenever you subscribe to the issue, it comes in electronic form in your demat. Very efficient mechanism. They follow what is called as a book building approach. Essentially, they try to generate interest in a security, find out what the orders would be like, and then fix the price. They will say price band between 50 and 60 or whatever. They will fix the final price after assessing the demand for that security at various prices through a process called book building. These are some important changes that are taking place in security markets as far as the primary securities. The secondary market has seen revolutionary changes. We have moved to screen-based trading. Earlier it was open outright trading. People would assemble on a trading floor, make gestures, cry, shout, out, arrive at trades in manner which was very, very difficult for any outsider to understand. Okay. Now with this screen-based trading, nobody is at an advantage. You can trade in the privacy of your living room, electronic settlement, all trades are settled electronically, all holdings are in dematerialized form. You have clearing corporation which interposes itself between the buyer and the seller. Let me explain the role of clearing corporation. Let us say I A buys 100 shares of Reliance at 9.95. B sells 100 shares of Reliance at 9.95. A and B don't trade between themselves. Between A and B, the clearing corporation interposes itself. It means A is a buyer, CC is the seller. B is the seller, CC is the buyer. They get the role played by the clearing corporation. Now A is not bothered who the counterparty is. There is no counterparty risk whatsoever. B is not bothered who the counterparty is. The clearing corporation interposes itself between A and B to guarantee all trades in settlement. That is why I have said markets have become extremely safe. There is no risk whatsoever. That's a very important role played by the clearing corporation. Foreign portfolio investment has become very dominant in India. Derivatives have thrived. All this has led to greater volatility in the market. As I said, there has been a virtual metamorphosis, and I have already mentioned last prepaid trading, dematerialization, rolling settlement. This is also important. Earlier, the trading cycle was 15 days. Now, every day constitutes a trading cycle. All trades on Monday will have to be settled in the following 2 days. I can't buy on Monday and then sell on Tuesday. I can't square my position like that. Earlier I could square my position over a fortnight period. Today, every day represents a settlement day, whatever. Of course, intraday trades can be made. If I buy at 11 o'clock and sell at 2 o'clock, I am doing an intraday trade. Then I don't have any outstanding position. Only price difference is exists. Is that clear? As I said, NSE has virtually transformed. I would say NSE has assured India into a modern world, and BSE, which traditionally followed very, very archaic practices, also has caught up with it. So you can trade easily on whichever exchange you want to. The system of trading that we adopted is called electronic limit order system. Buyers and sellers place their orders on the computer. They can give a limit order or a market order. Let me explain the difference between the two. These are the kinds of orders you can place. You can place a limit order or a market order. A market order is an order which says, I want to buy 100 shares of Reliance at the best available price. Okay? Reliance may be trading at 9.95, or I say I want to buy 100 shares at a price less than 9.90. I can specify my limit. I observe the latest price to be 9.95, but I place my order at 9.90. That is called a limit order. If the price falls during the day to 9.90, my order will be executed. Otherwise, my order remains unexecuted. Likewise, if you are a seller and you observe the current price to be 9.95, you can say, I am interested in selling 100 shares at 1,000. That is called a limit order. A limit order is executed only when the limit stipulated by the order giver is satisfied. Is that clear?
So the limit is only for that?
Yeah. There it is. Now you can instruct your broker, you say this limit is valid for 3 days. Broker will have to reactivate that. Then there is an order, and these are known as price contingent orders. You know, these orders have to be executed only when the price reaches a certain level. Then you have what is called a stop loss order. Let us say someone tells me buy Reliance at 9.95, it will go up during the day to 10.10. That is the advice you get from morning to evening. Is it not? Buy at 9.95, it is likely to hit a target price of 10.10, but they say put a stop loss at 9.90, which essentially means that the market moves adversely, you cut your losses. That is known as a stop loss order. You want to enjoy the upside potential, but limit the downside risk. Is that clear? Likewise, you may say, I am willing to buy whenever the price rises about 110. What does that mean? It means that you believe that once the price rises about 110, there will be further momentum upward. Just the way in a stop loss order, I want to curtail my losses. In a stop buy order, I say, I want to buy only when it crosses a certain threshold, because my technical tool tells me that once it crosses 10.10, the next stopping point is 10.50. This is what technical analysts do all the time. They try to gauge market psychology, and they believe that there is a momentum in the market. If the market is spiraling downwards, it will spiral downwards. If the market is spiraling upward, it will move upward. All this is based on psychology, right? So you have price contingent orders and market orders. I often place a market order because I'm a long-term investor. But recently I decided to buy a stock. I told my broker buy 500 shares at the best market price. I'm not interested in the price to fall and then buy. I don't know where the price will go next. It can go down, it can go up. I'm not a person who is going to fine tune all that, because I buy a stock with a view of holding it for 3 to 30 years. Let me put that way. I've been holding stocks for even 20 years now. As long as the story is good, you should not liquidate your stock. Build a portfolio gradually over a period of time of companies that you enjoy, trust, and regard highly. That is a way to build your finances gradually. Then this has become very important these days. What is called algorithmic trading, algo. Yes. There are trading based on a program written by an analyst. Some of you may have written these programs with predetermined parameters, jobbing, arbitrage, trading, and so on. It is an automated process with no human intervention. All trades are generated by a computer which runs on an algorithm, which takes into account the market price, trading volume, so on and so forth. There is no human intervention whatsoever. This is known as algorithmic trading. Believe me, today 50% of trades or even more are algorithmic. Thanks to technology, computers are replacing human beings. People want to execute trades very fast, because when you are engaged in trading activity, you want to delegate to a computer which takes a fast decision. Otherwise, the human mind will have to process that price movement and then decide whether to buy or sell, and if to buy, how much to buy, so on and so forth. Here is a computer which generates orders all the time based on certain algorithms that drive the. And there is a variant or part of this algorithm trading which is called high frequency trading. high frequency trading. Now, high frequency trading is a part of algorithmic trading that relies on high speed networks or co-location facilities which are located in the proximity of the exchange platform. If you go to BKC, you have natural stock chain. So you co-locate your system in the proximity of the NSA so that you have a microsecond advantage over someone in Latur. There is no high frequency trading. It is algorithmic trading done by computers, co-located in proximity of the server of the exchange. There is a lot of hue and cry. SEBI has been flooded with complaints by people in Latur and Nagpur saying that these people who are based in BKC have a great advantage over us because there is a market driven by information all the time. These are trades which now account for the bulk of the trading on the exchange. And all algo trades essentially say buy, sell, buy, sell, buy this stuff. They look at those minor price variations, detect certain patterns, apply technical tools and induce trade. That's how this market evolves. If you're a long-term investor, forget about all of these things. Do your analysis every month, decide how much you want to invest. If you like a certain stock, gradually build it for a period of time. Give a monthly order to your broker and forget about all of this. Do not watch CNBC, do not watch ET Now. Market is a huge distraction. Yes.
This is the way markets are doing. Companies trust the price because they are.
No, you don't have to trust the price. In fact, you should enjoy when the price becomes apparent. That gives you an opportunity to buy. You have to do your valuation. The way you have to be an investor is to look at a company, understand its fundamentals, do a valuation, and you may say, I am comfortable if Reliance is in a range 800 to 850, or Reliance in range 900 to 950, and I forget about. Only when the price of Reliance, after all these millions of people are actively trading and speculating, comes in that range, am I a buyer? Otherwise, I am happy with my cash and cash equivalents. That's right. And what happens is when you have all kinds of trades of this nature, the market tends to be far more volatile. A volatile market is a friend of a long-term interest. A volatile market provides you an opportunity to buy when the stock drops precipitously. A volatile market gives you an opportunity to sell when the market rises. Do you get the point? The price of the market is based on demand and supply. And demand and supply are based on human psychology, by and large. Are you getting that argument? Let me present a graph to illustrate this point. Please look at this graph very carefully. Please look at this graph very carefully. What happens to a well-managed company over a period of time? All of you have studied corporate finance. Companies plow back 50, 60, 70, 80% of their profits. Grow over a period of time. I have been invested in companies 20, 30 years and I know that they grow over a period of time. Because they plow back 50, 60, 70% of their profit. So the intrinsic value of the company goes upward over a period of time. Look at well-managed companies. I'm not talking of fly-by-night operators. I'm talking of well-managed companies, and you should develop over a period of time a skill to identify such companies. What happens to the inherent or intrinsic value? Okay? Gross volatility. Yes, you'll always have problems. That is why one of my quantitative principles is you must have a diversified portfolio of at least 15 stocks. I will come to all these rules one by one. Now, the market price. Now, let us say the market price moves like this. Price is very close to the intrinsic value. Now look at this situation. Which situation would you prefer? A, B. You will prefer A if you invest regularly and you don't bother too much. You will prefer B because it gives an option to buy when the price drops very sharply and an offer to sell when the price rises. So, volatility becomes a trend of a long-term value investor, but an enemy of a short-term speculator. And that is why I said short-term speculators in general collectively pay a fee to the financial services industry, period. For all the thrill and joy that they want to have of trading frequently. I am trying to convey a very powerful message. I said human beings want excitement, human beings want action. And the market provides that. I often say stock market provides the most fertile ground for nurturing innovations. So, let us face reality. The market is something like B, not like A. And in B, if you are a short-term speculator, you tend to be a user in long. However, if you are a disciplined investor, you are a winner. How do we measure the state market? We look at indices, okay? Which are the two most popular indices today? Yes? Nifty and Sense. Sensex has become the barometer of national economic consciousness. The Prime Minister will talk about Sensex, the Finance Minister will talk about Sensex, everyone will talk about Sensex, right? Sensex has a longer history. And internationally, S&P 500, Dow Jones, FTSE, Nikkei 225, all these indicators are part of common man's vocabulary these days. Markets have become so pervasive and intrusive that everyone knows, because whatever media you open, you are constantly bombarded with that information, day in and day out. How are these indices computed? There are different ways of computing a market index. The three methods that are widely used are the price-weighted index, value-weighted index, and equal-weighted index. Price-weighted index, value-weighted index, and equal-weighted index. To illustrate the linear computation, let me work with a very, very simple and stylized example. let us say this is a base date, initial price. There are two stocks, A and B. All these indices reflect the movement of the market as a whole. In order to capture that movement, we work with a sample of 30, 50, 100, 500. The market has 3,000, 4,000, 6,000, 10,000 stocks. So we work with a small sample. To illustrate the integral computation, I am working with a sample of 2. Whether it is a sample of 2 or 50, the methodology remains the same. So you have two stocks, A and B. Initial price 25 and 100. After 1 year, the price of A is 30, the price of B is 90. Is that clear? By definition, the value of the index in the base period would be 100. Okay. Typically, the base period value by definition is 100 or 1000, whatever base period you choose. Okay. Now, 20 million shares of company A are outstanding. Only 1 million shares of company B are outstanding. Because if you look at the share capital of the company, some companies have issued 5 billion shares, some companies have issued 10 million shares. So, number of outstanding shares will vary from company to company. Now, initial value of all the outstanding shares of company A would be 25 multiplied by 500. Okay? Initial value of all the outstanding shares of company B would be 100. Okay? So, the initial value of all the outstanding shares of A and B put together is 600 million. Are you with me? Follow these numbers carefully because you will have to look at these indices from time to time. Now, the final value is 690, 30 multiplied by 20, 600, 90 multiplied by 190, 690. Okay. Price relative. Price here, relative to price here is 120. 30 divided by 25 into 100. That is called the price relative. And price relative here is 9. Are you clear about these concepts? Now, price weighted index. The price weighted index is calculated very simply. You simply add the prices. You don't bother about the volumes or number of stocks. Okay? 30 plus 90 is 120. 25 plus 100 is 125. 120 divided by 125 into 100. That is known as the price weighted index. This index makes sense if you have bought one share of each of these companies. If you buy, imagine that you are buying a single share of A single share of B, and the price that you pay for both these shares put together is 125. At the end of 1 year, the value of your holding is 120. So your index is 96, between 100 has declined to 96. Is that clear? Price relative is 30 in relation to 25. 30 by 25 into 100. Yeah, for every stock, price relative of A in year 1 is equal to 120 of its price in year 0. Is that clear? 90 by 100 into 100 is 90. Is that clear? So, as far as price weighted index is concerned, the basic assumption that you bought a single share of each of those companies in the index. Oh, let us look at value weighted index. Here, the total value of both the stocks put together in the base year is 600 million. Total value of both the stocks in the index is 690 million. So this is known as aggregate market capitalization. Aggregate market capitalization is 600 million in year 1, year 0, and 690 million in year 1. Is that clear? So I have this calculation, 690 divided by 600 into 100 is 150. Aggregate market capitalization is what matters for investors as a collectivity. All investors put together have experienced a gain of 15% in their aggregate market capitalization. Is that clear? This is the most popular methodology for computing stock market indices. By the way, NSE and BSE indices are value-weighted indices. Value-weighted indices reflect the collective experience of all investors put together. Then you have an equal weighted index. Imagine that you have some money and you put that money equally across all the stocks in the index. Then your money would have grown by 5%, and that is where price relative comes into picture. 210 divided by 200 into 100. If I have 100 rupees to invest, I'll invest 50-50 equally in A and B, or if I have 200 to invest, I'll invest 100 equally in A and B, and the value of my portfolio would have appreciated by 5. So these are 3 ways in which we compute. Yes. Any questions? Equal weighted index means that you are allocating the same amount of money to each stock in the index. Okay? Same amount of money. If I have said 200 rupees to invest, I will put 100 rupees in A stock, 100 rupees in B stock. Price weighted index means I will buy one share of each stock. Do you know the difference between the two? In the first case, you are buying just one share. In the second case, if I have say 5 lakhs to invest and there are 5 stocks, I will put 1 lakh each in all those 5 stocks. Is that clear? Huh? No, because I look at the price relative. Price relative here by definition is 200, okay? Price relative is price in the terminal period by price in the base year, okay? Price in the terminal period by price in the base year. Right. Price in the base year by price in the base year is 100. Price in the base year by price in the base year is 100. So if I have 200, here you will have to buy fractional shares, okay? Imagine that I have 200 to invest. I invest 100 in A, 100 in B. Yeah, no, I am investing 100, so that share is available for 25, so I would have bought 4 shares. Okay, I invest 100 in B, so I buy only 1 share. So I have 4 shares of A, 1 shares of B. Now those 4 shares will be 120 rupees, and that 1 share will be 90. So my terminal wealth is 210. My initial investment is 200. Is that clear? And that is what many investors do. If I had 10 lakhs to invest and I decided to invest in 5 stocks, I may put 2 lakh each, 2 lakh each, 2 lakh each. It takes a lot. To summarize, a value-weighted index represents the collective experience of all investors. A price-weighted index shows what happens if you buy 1 share of each company. An equal weighted index tells you what happens if you allocate your funds equally across all stocks. Is that clear? This is how we tend to behave, and these are the ways that we capture these things.
You mentioned the Sensex and Nifty are valued by
Yes,
And is it true for the other institutions?
I think let me, yeah, add it. Dow Jones is a price weighted index, S&P 500 is a value weighted index, Nikkei 225 is a price weighted index, FTSE 100 is a value weighted index. Okay. The most important indices in the world are value weighted index because people want to know the collective experience of all the investors. And that is how it should be. What is happening to the aggregate value of investors. Now that you understand these concepts, a little exercise involved there. Please do. And this is 3016 here. As I said, value index looks at the aggregate market capitalization in the current year divided by aggregate market capitalization the base year multiplied by 100. Is that clear? Collectively, investors have experienced a gain of 30% over this period. 100 has become 130. Is that clear? Shall we move on? Right. Yes. Right. Right. Yes, yes. Let us not be too fastidious about the decimal point. Right. Yes?
Already lower,
Which one?
the equal visit index is generally lower than the overall price material.
I think we can't generalize like that. Okay. Because if there is penny stock which has become very, very valuable after some time, and you had allocated the same amount of money to that, it would have grown phenomenally over that period. Okay. Because the equal weighted index means that you are allocating the same sum to every stock. And if there are a few penny stocks to which you have allocated, say 1 lakh each, and that 1 rupee has become 500 rupees, then you get a very different picture altogether. Okay. As I said, Sensex is, I often, I was a member of Sensex committee for 2 years, and I used to joke with my colleagues. I would say, this index, Sensex, has become a barometer of national consciousness. It is more of sex and less of sense. Now it is what is called based on what they call as floating stock. They make a distinction now. Let us understand what it means. If you look at TCS, 74% is held by Tata Sons. Only 26% is held by the general investing public. So when we are calculating the aggregate market capitalization of TCS, we won't say it is 450,000 or 420,000 crore, whatever it is. It will be 26% of that, because it is known as an index based on floating stock. And floating stock is defined as stock held by non-promoters, because that is the stock currently available for buying and selling by others. It is assumed that promoters are long-term strategic investors. They don't come into the market to buy and sell. So all these are known as floating indicators. Look, for example, Axis Bank. Adjustment factor is 0.7. What does it mean? Only 70% of the equity of Axis Bank represents floating stock. 30% is held by promoters. So you have adjusted market cap here, Likewise, Bharti Airtel 0.3, BHL. Look at a company like Coal India, only 0.1. What does that mean? It means 90% of the shares held by Government of India represent statutory holding. So we have to understand this how the index is computed. This is a Sensex computation taking into account the floating stock. Even Nifty is also based on the same.
They only consider floating stocks for computation.
Yes, yes. That's why you have that adjustment factor. As I said, in Coal India, 90% held by Government of India. So they look at the market capitalization of Coal India, multiply it by only 0.10, because that is the value of the floating stock available to other investors. So the computation is based on aggregate market capitalization of floating stock only. Is that clear? As I said, in the case of TCS, only 30% is held by non-promoters, 70% is held by promoters. Yes?
Their stock like HDFC, ICICI,
Yes, yes.
and LNB.
Yeah, HDFC floating stock is very, very high. You know, HDFC is owned literally by foreign investors. Promoters collectively own only 20%. Is that clear? L&T, for example, is fully owned by non-promoters. If you look at L&T, L&T does not have any promoter. So the entire stock is floating stock. So the adjustment factor is 1 thing.
HDFC is also one.
HDFC is, yes, HDFC is 1. HDFC Bank is 0.8.
Yeah, I was talking about HDFC.
HDFC is 1, you know.
So it typically is not floating.
Yes, yes, HDFC does not have any well-identified promoter group. You know, where HDFC Bank has been promoted by HDFC. So 20% of the equity of HDFC Bank is held by HDFC, which is a company. Okay. Other indicators that you have to bear in mind are P multiple. What is the aggregate P multiple in the market? Aggregate market capitalization divided by aggregate corporate revenue. Okay? Aggregate market capitalization divided by aggregate corporate earnings. Now, here I am not looking floating stock, I am looking entire stock. Is that clear? If today I ask a very simple question, what is the market capitalization of TCS, the most valuable company in the country? It may be, say, 420,000 crores. It has fallen in recent weeks. 420,000 crores. Reliance, 300,000 crores. Now I have the aggregate market capitalization of these companies. I add all these values and I come with a figure called as the aggregate market capitalization of Indian equity market. The figure may be 80 lakh crores. I am just giving an illustrative number. Is that clear? There is the aggregate market value of all listed companies. Then I start asking a question, what is the aggregate earnings of all these companies? KCS may have an earning of 26,000 crores, Reliance may have an earning of 28,000 crores. I add all these numbers and I get a figure of, say, 3 lakh crores. In the numerator, I have 80 lakh or 60 lakh crores. Divided by 3 lakh crores, I get a multiple of 20. This is the most important indicator. It is known as the aggregate P multiple for the market. What is the relationship between aggregate market cap and aggregate corporate earnings? Today, P multiple of the market is slightly above 20. Are you with me? We want to know how expensive or cheap the market is relative to other markets. Indian market is relatively more expensive vis-a-vis other emerging markets because there is a lot of interest in the Indian space. Now this multiple is calculated in three ways. You have to understand that because the entire discussion in the equity market will surround around these multiples. You have a retrospective multiple. What does it mean? It means that I am looking at the aggregate market capitalization of all equities listed on the exchanges. I find the number to be, say, 6 lakh crore, 60 lakh crore. Then I ask what is the sum of earnings of all these companies for the year which ended on 31st March 2016. Because I have data on all these companies on an annual basis up to 31st March 2016. Now I am relating a price value today when I am in November to something which relates to 31st December, 31st March. This is known as a retrospective multiple. The second multiple is a trailing multiple. I don't look at aggregate earnings till 31st March 2016. I look at aggregate earnings for a 12-month period ending on 30th September because I have information for these companies. That is known as a trailing 12-month multiple. I am looking at the yearly earning, but the year is now defined as 1st October 2015 to 30th September 2016 because that's the latest information I have. Then I look at another multiple called the forward multiple. They are very commonly used in the stock market discussion. They don't look at past earnings, they look at projected earnings. What is the likely earnings for 2017 March? What is the likely earning for March 2018? These are known as forward multiples. You will now realize that depending on what you want to sell, depending on what you want to argue, you can compute a multiple that suits your needs. If you want to convince investors that it's a great time to buy, you work with a forward multiple. And what you do in that analysis or discussion, you assume that corporate earnings will rise by 20%. All these are assumptions. So I want to sensitize you to the fact that these are very important numbers which guide the investor thinking and decision making. They can be manipulated subtly by people in the financial services industry. If I am conservative, I look at the trailing 12 months. That is historically paid. I look at trailing 12 months, and trailing 12 months are available for retrospective figures, then only retrospective figures. Then you have another multiple called the price to book multiple. Aggregate market capitalization, as I said, the figure may be 60 lakh crore, and then you ask what is the aggregate corporate net worth. For every company, you know what is the shareholders' fund, which we call as net worth. Okay. If I look at TCS, net worth may be 70,000 crore. If I look at Reliance, net worth may be 150,000 crore or whatever. Add all the shareholders' funds or net worth across all these companies. That's known as price to book ratio. These are three numbers which will loom large in investment discussion. I'll probably give you a little flavor of the derivatives market, big subject, but at the same time, I won't bother you with money market, etc. You're familiar with options and futures? Have you been introduced to options and futures? Yes. That's the largest segment of the securities market. So, let us look at call option and put option. Would you be interested in this discussion?
Yes.
Forward. Okay. A call option gives the right to buy. A put option gives the right to sell. Let us say, I don't have money. I am bullish on Reliance. I believe Reliance will do well Reliance is currently trading at 1,000 rupees, Reliance will go to 1,200. All investment decisions are based on expectations. All investment decisions are based on expectations. I believe that Reliance can go up from 1,000 to 1,200 in a year's time after Jio's rollout, so on and so forth. I don't have money to buy Reliance. If I want to buy 100 shares of Reliance, I need 1 lakh. I don't have 1 lakh now. What do? I buy a call option. A call option gives me the right to buy 100 shares of Reliance. 6 months from now, I can buy a call option which matures after 6 months. 6 months from now, which means that I am bullish on Reliance. I expect the price to go up from 100 to say 1,100 or whatever. Not everyone may share this enthusiasm about Reliance. A is bullish. So A buys 100 or call options worth 100 shares, that we call 100 call, or a call for 100 shares, and B is bearish. B is bearish. B believes that Reliance will stagnate at 1,000 or even decline, because after Jio rollout they may incur a lot of losses in that venture and market will react very adversely. Everyone is looking at future from a different perspective. B is bearish. So B sells the call. B sells the call to A. Now, the nature of this contract is very unusual. A has the right to buy 100 shares of Reliance at an exercise price of, say, 1,020. Current market price is 1,000. A has the right to buy 100 shares of Reliance at a price of 120 over the next 6 months. A need not exercise that right. A buys a right. A call option gives you the right but not the obligation. In order to enjoy that right, A pays a premium of say 10 rupees. The premium is determined by market forces depending on how investors take view on how the prices will move. Is that clear? All these are market determined, reflecting the expectations of millions of investors who are participating in this gigantic market. So he pays a premium of 10 rupees, which means he pays only 1,000 rupees as premium to B to enjoy the right to buy 100 shares of Reliance at an exercise price of 10.20 over the next 6 months. What is A's view? A thinks that price will go to 1,100. He can buy at 10.20, which is exercise price, gain 80 rupees. He would have paid a premium of 10 rupees, deduct at 10, and he has a gain of 70. What is B's view? B thinks that the price will not go beyond 10, come what may. He has already collected a premium of 10 rupees. If the price goes up to 10, he is safe. And if the price is less than 1,000, he makes money. A has to give a premium to B B has an obligation to sell to A if the A exercises right. So it is an asymmetric contract. A pays a premium of 10 to B. A enjoys the right to buy these shares. B collects that premium of 10 rupees and he has to oblige A whenever A exercises the right. It is like an insurance contract. A is buying an insurance from B. What happens in an insurance contract? You pay a premium. If your vehicle is damaged, you can claim from insurance company. The insurance company will have to honor the contract if your vehicle be damaged. Is that clear? So it is an asymmetric contract where A benefits, the price moves upward. A loses, the price doesn't move
We
upward.
need to provide B as also part of option.
Yes,
You
yes.
need to buy that share at that point of time, but in case A exercise that right,
Huh.
B need to buy that. And
No, they will settle the cash, settle the difference by cash payment. You know, let us say after 6 months, the price happens to be 1100. Now, A exercises at 1020, then the 80 rupees difference. So, A will receive the price difference of 80 rupees. All these are cash settled. That's why everyone is enjoying the game. They have dividend views and everyone thinks it's very smart. As I said, ultimately the primary beneficiaries are the brokers who introduce these transactions. Period. Nobody else benefits. Otherwise, it's a gigantic zero-sum game. It's, huh? Yeah, brokers and exchanges make money. And unfortunately, the government also makes money. There is a securities transaction tax. So government is happy collecting its securities transaction tax. Exchanges are happy because they get benefit from turnover. Brokers are happy, they get benefit from turnover. Millions of investors are happy because it provides a speculative arena. But if you look at it at the end of the day, it's a gigantic zero-sum game as far as investors or speculators are concerned. It is a positive sum game for brokers, for exchange, for the government. Do you get the point? Yes.
So if the prices drop and he has already paid the premium, then does he have
Yeah,
to
forfeit
not
it.
pay?
No, it is like taking insurance policy. I bought an insurance cover for my car. If my car doesn't meet in an accident, I can't ask the insurance company to refund the money. A pays a premium to enjoy that right. If he allows that right to lapse, the premium is foregone.
The premium is gone, but does he have the right not to take the
Yes, yes.
funds from the
Yes. He enjoys the right to buy at 1020, but not the obligation to buy at 1020. He will exercise that right only when the price moves upward. Otherwise, he will allow the right to put. It is like a car insurance. Anyway, do you get the point? Wonderful instrument. A put option is an option which gives the right to sell. A call option is an option which gives the right to buy. I will buy a put option if I believe the price is going to drop. I will buy a call option if I believe the price is going to rise. So options have become a very important instrument in financial markets. Then you have another kind of contract, and remember, these are asymmetric contracts. These are asymmetric contracts. A has the right but not the obligation, whereas B has to honor the contract if A exercises his right. So these are asymmetric contracts. Then you have another major derivative instrument called the futures contract. This is a symmetric contract. This is a symmetric contract. A and B agree to exchange Reliance 6 months down the road at 1050. asymmetric in the sense, as far as this contract is concerned, if you look at the payoff, if I ignore for the time being, let us look at it from the point of view of A. Okay? He has bought a call option at a certain premium. Let us say the exercise price is 10.20. Okay? He has paid a premium, and if in future, and he has paid a premium of say 10 rupees. If you look at his payoff, it is like this. If you look at his profit, it is like this. He tends to lose the premium amount if the price is below 10.20 exercise price, and as the future price moves upward, he starts gaining. There is an asymmetric payoff. Now let us look at a futures contract. In a futures contract, A and B enter into an agreement to exchange Reliance at a price of 10.50 6 months from now. A and B enter into an agreement wherein A would buy one share of Reliance at 10.50 6 months from now, and B would sell. It is not a right, it is a definite commitment. Here you don't have to pay any premium because both of them have agreed to do that transaction 6 months from now. What happens in such a case? If you look at it from the point of view of A, 6 months now they have, these are only contract price, 10.50. They will exchange this share 6 months now at 10.50. If the price happens to be 1100 or 1200, as far as A is concerned, he will benefit. Because he is buying at 10.50, the future price would be 1200. But if the price falls, he will lose. Is that clear? If the price falls, he will lose because he has to buy at 10.50, come what may. He is not paying any premium whatsoever. That's the payoff for A. That is why this is a symmetric payoff. Irrespective of which way the price moves, there is a positive side as well as a negative side. Now look at it from the point of view of B. His payoff will be like this. Is it not? As far as B is concerned, he gains if the price is less than 10.50 because he agreed to sell at 10.50 what may be available at 900. And he loses if the price rises to 1200. So you have a symmetric payoff. Whereas in the case of a call option, this will be the payoff for B. Is it not? Look at it carefully. As far as B is concerned, he enjoys a premium as long as the price doesn't rise above a certain level. And when the price starts rising, he loses. The gain of A is the loss of B. Are you clear about the difference between a symmetric payoff and an asymmetric? Yes.
Options you said that actual shares are not transacted.
No. Everything is settled in cash.
Futures also.
Everything is settled in cash. They made it so convenient for you to play that game all the time.
So the shares are not
No. Everything is all cash settled. That is why I am saying they have created a very wonderful platform for us to engage in speculative trading all the time. Eh?
who owns the shares at the end of the
Nobody owns, nobody ends. So if you settle the cash difference, it's like saying, yeah, I am bullish in Reliance, I think it will go to 1200, so I will enter into a contract at 1050, he is bearish, he will enter into a contract at 1050, the price comes out to 1200, he pays me the difference in the match.
It's kind of a forward contract.
Yeah, forward. Futures contract is a standardized forward contract which is guaranteed by the exchange. because they're concerned about the default risk. So they have created a platform which is so enticing, so tempting, so captivating. Human beings are born with this gambling instinct, period.
It's very close to betting then.
Yeah. Nothing different from that. These are all devices of mass speculation. Please understand that. As I often say, I've been involved in this market over now close to 5 decades. This is a huge distraction. I'm not saying don't participate in it. I'm saying if you're participating in it, please understand it is not very different from going to Las Vegas. I'm making this observation very, very responsibly. Have you ever been to, I'm sure many of you have gone and played at Las Vegas. How many have gone to Las Vegas and played? Okay? When I went there on 2 occasions, I found some very interesting things. You have a machine, right? And they're very, very, very candid and forthright. What does it say on the machine? Yes?
Slot machine.
Yes, sir?
Success rate is 95%.
Yeah, he has said it correctly. Expected payoff, sometimes they say 95%, sometimes I found 2 numbers in my experience, 97%, 95%. What does it mean? If I keep on playing that machine for hours together, and if I play $10,000 at the end of that period, I'll be left with $9,500. Is that clear? The entire securities market is like that. Yes. The entire financial industry is like that. As I said, now who gets this 5% or 3%? The casino owner. And who gets that 5% or 3% in the securities market? Government, exchanges, and brokers. Is it? So don't get an impression that you can beat in the long run. I often say, if you want to play a game like this, it is speculative instinct. Las Vegas may be a better place. You'll have more fun there.
But
Yes.
the positive thing about it, right? For a lot of businesses which are in commodity-based raw material industry, they use this as a
I'm talking about ordinary investors like you and me. Derivatives are extremely useful for hedging purposes. I'm an oil producer. I want to sell my expected production futures in market. What am I doing? I'm hedging myself. I'm likely to produce 1 million barrels 3 months down the road. I don't want to expose myself to price volatility. So I'm selling in the futures contract. That is hedging. This is not hedging. This is pure plain speculation by and large. Yes, in some cases we hedge. I have a portfolio of say 2 crore rupees. I want to protect my portfolio. So I buy a put option on the index. That's hedging. They are excellent tools for hedging, but they are very, very undesirable tools for speculation. Okay? Yes.
how does we take the profit if the price doesn't rise? We can always give it, right?
You're talking of the call option.
Yes.
As long as the price, remember, as far as we concerned, this is gain. If the price moves beyond that, it starts losing. Yes. It is like the insurance company. You just collect your premium 10,000 rupees from for a car insurance. But if your insurance claim is less than 10,000, they still make money. If the insurance claims are more than 10,000, still lose. In a way, B is providing insurance to A. Okay, I overshot my time, but I wanted to give you a flavor of it. In the bigger book, I have a lot of technical discussion that I don't want to talk about. Okay. So, a special request, I have given you outline with what you have to read. If you read the relevant chapters in come, you'll be able to discuss a few more. More important is you can ask some questions, otherwise yes, you are supposed to read all those chapters very, very carefully. The examination will be based on the kinds of exercises and the book.
Is it open book?
Yes, ma'am.
Is it open book or
And
open book exam or?
how many of you will want an open book examination? I'll go with the majority. It doesn't make any difference. All the chapters are from this book only. I have given in the course outline the chapter that you read for various See, your best preparation for the examination would be to work out all the problems I have given. I have also given you the solution. Please don't look at the solution. Work at the problem and then compare with it.
So you'll be asking the problem.
I need a little freedom there.
No,
I have granted 1 degree of freedom by forfeiting my right of holding for examination. It will be problem-centric primarily, but I get to think about it. Okay. Oh. But more important, yes. Yeah. Will you know the sessions are there tomorrow? Yeah. If you read them, you will be able to get more out of the discussion. No, I am making a request because we are here only for 5 minutes. It is a longer evening and do it at once. Okay, I'll leave my telephone number. Any questions? Is my